Onto the broader markets here. The S&P 500 is sitting right at a record high. The next big catalysts come after the bell. We're going to get Alphabet and Tesla reporting results. Joining us now is Michael Nicolas. He's Oakmark's portfolio manager. Alphabet is amongst his top holdings. Good to have you this morning. You know what? I want to get to Alphabet, but I notice as well sort of what differentiates your portfolio a bit is you have a big ownership stake. I think it's in Capital One, which reported numbers this morning. Stock is up. I'm just curious, sort of, Michael, what you see in that company and why you're, why it's a significant allocation for your account.
Yeah, we've owned Capital One for quite some time, and I think I talked about the same idea maybe last year on the show, but we thought the acquisition with Discover was going to be very beneficial to them. We thought pro forma for some of the synergies that we had put into our model that the stock was trading at that time at a high single-digit multiple of earnings, and it was good to see some of the results that we saw last night coming out of there, with the net interest margin improving a bit and credit performing quite well. You know, we think it's one of the best run financials that's out there, and continue to be a pretty material position in our fund. Yeah,
they seem to have ambitions, and Jim Cramer was talking about it earlier on our show, you know, sort of globally, and to really take on some of their competitors. You think they're going to be successful in that?
We do think they're one of, just a handful of very scaled competitors that can compete in the card market. It is a good market that if you have the scale, can earn pretty healthy returns. But we do think the integration with the network will put them in a much better position to compete, both domestically and globally.
All right, let's talk a little about Alphabet, given we're going to get earnings. Down today, but it's up, I think, 10 straight sessions. It's clawed its way back to even on the year, has the stock. One of the main concerns out there, I think it continues, is simply they're losing their monopoly, so-called, in search. How many people now, when they're searching, so to speak, go to OpenAI or one of the other LLMs? Is that not a concern to you?
No, it absolutely is a concern to us. I think a couple of years ago, most people would have been hard-pressed to come up with the disruptive threat to search. And today, I don't think that's the case. With artificial intelligence and maybe ChatGPT in particular, our view is the range of outcomes around Alphabet's search business has widened. We typically respond to scenarios like that by increasing our discount rate or reducing our estimated business value for that segment. But it's important to remember that Alphabet, has been investing in AI for a long time, has a lot of resources to compete there, and frankly is more than just search. I heard you guys talking a little bit in the earlier segment, but when you think about the collection of assets away from search, you have, of course, a large cloud computing business, which should be a big beneficiary of AI if the bull case plays out and adoption continues to increase. But also things like YouTube and Waymo and a number of other bets. Of course, they own Android as well. So we think these other assets account for a pretty healthy chunk of Alphabet's market cap today, with the implication that the market's already applying a very low multiple to the core search business. So, the stock has held in there quite well this year. It's, performing well fundamentally still, but the gap to intrinsic value has narrowed for us.
Yeah. I mean, some of the parts become important here. Obviously, we continue to monitor the cases of the U.S. government versus Google and what the outcome is going to be in terms of any ultimate decisions there. Is that a concern or is that an opportunity in some way?
Yeah, we've always approached our analysis of Google into some of the parts, and I think you have to. There's so many businesses under the hood, some of which are non-earning or under-earning. And if you were to just take the earnings on the face of the income statement and slap a multiple on it, you'd be valuing some of these businesses at a negative that we thought had very positive value. So we've always thought about it piece by piece. And we are concerned about competition and regulatory, but I don't think it's lost on the market with Alphabet below a market multiple on reported earnings and well below a market multiple on search.
Yeah, I was going to ask to justify sort of the case for value on Alphabet after it's had such a strong run-up, just particularly in the last few months. I mean, you clearly think it's value. And some of the other names in your portfolio, they're financials in your value strategy, like a Schwab and a Bank of America. I mean, is it harder to find value in large cap stocks right now with stocks at record highs?
I think if you would have told most people, 3 months ago, when the S&P was down 20%, that we'd be sitting here today back near an all-time high, they probably would have been skeptical. But we're not market timers, and we're always looking for the best positions that we can find within our opportunity set. So, to us, we're not having a difficult time finding opportunities. Now, you look at the S&P today, and there are some risks. You've got concentration risk, which you all have covered quite well. Of course, there's valuation risk at 23 times earnings. And you have style risk with growth outperforming value so demonstrably over the last decade. That might make me sound bearish, but we're really not. We still think the valuation dispersion beneath the surface remains unusually wide, which is an attractive environment for value investors like us. And we think we've put together a really attractive portfolio at a fraction of a market multiple and with less risk than what's lurking in these indices from a concentration perspective. So still finding new ideas.
All right, we'll leave it there for today, Michael. Thank you.